Yes,
Hello, everyone. We are Group 17. I am Fang Hawei.
I am Guo Yiming.
Today, we want to talk about a decade of investing dreams. The study aims to conduct an in-depth quantitative analysis of ETF performance stability in both the Taiwan and US markets. We aim to look beyond short-term trends and evaluate these assets across different time horizons. Next page, fleet the fleeted of time and performance bias. Taiwanese investing public exhibits an almost blind pursuit of high dividend ETFs. The behavior of fundamentally underpinned by recent bias. Investor conviction is currently built almost entirely on the strong broad market performance of the past 3 to 5 years, ignoring the necessity of multi-cycle stress testing. Next page. The core contribution of our empirical study lies in exploring why 10 years should be the golden standard. We argue it is far super for evaluating the stability of factor investing strategy than the common 5 year period. Next page. Look at our motivation. Recently, Taiwanese investors have blindly pursued high dividend ETFs based on recent bull market. These recent buyers ignore the necessity of testing assets across the complete 7 to 10 year jugular economic cycle. And the next page, we talk to motivation. Compounding turning point. Another motivation is the non-linear turning point of the compounding effect. Dividing reinvestment isn't very obvious with the 5 years, but it shows significant structural divergences in the total returns between the 7 and 10 years. Between the 7 and the 10 years, and the net page risk risk smoothing from an asset management perspective. Risk produce a smoothing effect over time. We want to qualify the convergence speed of risk-adjusted returns between low volatility, high dividend assets and high growth market cap assets. Next page. 5 years. Why 10 years? 5 years back tax is highly susceptible to interference from the single rate hike or cut cycle. In contrast, a 10-year period covers a complete economic cycle, significantly reducing period bias. Next page. Furthermore, while the dividend reinvestment effect is not obvious over 5 years, the 10 years time frame allows compounding to produce non-linear growth divergences. This strictly reflects the total return reliance of high dividend assets. Finally, short-term backtests give each event this proportionally high weight over 10 years rather than locations offset each other through mean reversion, which guarantee enhance the statistical power of the research. And the next page.
Based on the law of large numbers, we accept the depressions of the Sharpe ratio from high dividend ETFs to be significantly lower over a 10-year window. Okay, next page. Although market cap assets have higher capital gains, the continuous dividend reinvestment of high dividend assets over 10 years will significantly reduce the total return gap in a bull market. Next page. Due to market volatility crossstream, we hypothesis that the maximum drawdown recovery period for high dividend ETFs after systemic risk is significantly shorter over a full cycle. Next page. We believe investors' judgments on whether high dividend or market cap is superior will experience a straw break as a backtesting span change from 5 to 10 years. Next page. In the Taiwan market, we compare market cap ETF like 0050 and 006208 against high dividend ETF like 0056 and 00878. Next page. We use VOO and SPY for market cap exposure, representing beta and size, and VYM and SCHD for high dividend exposure, focus on value and yield. And next page. This helps us overcome the randoms of arbitrarily selecting start and date for our back texting. Next page. We slice this data into all overlapping 60-month windows, representing 5-year and 120-month window, representing the full 10 years periods. Next page. We calculate the cumulative return and the Sortino ratio, as a latter better reflects the downside risk of the investment during these periods. Next page. We accept this to show the 10 years box is significantly narrower than 5 years box, proving the superior predictability of long-term investment. This is
Thank
our
you for
this is our
yes.
presentation. Yeah, thank you.
Thank you for your listening.